for the first 5 years, and each year after that it decreases a little bit because the beta changes. So I have a shifting cost of equity. If I wanted to compute the present value of 476.86, what discount factor, or mechanically, how would I discount it? First, let's see what you cannot do. Can I take the 476.86 and discount it back at 9.5% for 10 years? I used the 9.5% to get the 476.86. Now that price out in 10 years, can I discount the 476.86 back 10 years and 9.5%? Why can't I do it? You know what these costs of equity are? They're 1-year cost of equity. They're like forward rates, right? You know how we do work with forward rates. If to live to get to year 10, I've got to live through the first 5 years. If I have a lot of risk in the first 5 years, I've got to build into my discount factor. You know how the actual mechanics of what you need to do? You'd need to take the 476.86 divided by 1.104 raised to the power of 5, because that's your cost of equity for the first 5 years, times 1.1022 to get the 6th year, 1.1004 to get the 7th year, and basically have a compounded discount factor. That's why if you look at all my DCF models, there's an extra line. Cost of capital, compounded cost of capital. I do that whether it's changing or not, simply to make sure that I get it done every single time. It's not going to get you into trouble if the cost of capital doesn't change, because it'll still give you the right answer. But if your cost of capital does change, you have to do that compounded cost of capital. And don't blow by it saying, how much of a difference can it make? It can make billions of dollars of difference. If you have a high-risk company that becomes a safe company, using the stable cost of capital to discount the terminal price back is going to give you a very misleading sense of value. So intuitively what we're saying is, to live to year 10, I've got to live through the first 10 years. So whatever risk I face is actually the risk I face over those 10 years, not the risk at the end of the 10th year. Okay? So file that away anytime you're changing discount rates. This is something that will affect your present value. Okay? Any questions? I'm sorry? The mechanics would be to take 476.86 divided by 1.104 raised to the power of 5, because that's your discount rate for the first 5 years, times 1.1022, times 1.1004, times 1.0986. So basically it'll be the compounded number over the 10 years in the denominator, exactly. In other words, don't use the PV function in Excel. It will only get you into trouble. So I know it's a sacrifice, because it's nice to be able to use the PV function. You cannot use that, though, if you have changing discount rates. Malik, you have a question? Okay. Here's a second way to think about these three firms. With all three firms, the way I valued them is I started with existing dividends. I put in a future growth driven by return equity, came up with the terminal price, discounted back. And I'm assuming you're doing the same thing for your companies. You might not be using a dividend discount model, but you're making assumptions about current earnings, assumptions about future growth, and coming up with the present value. Here's a question that I think you might be interested in knowing the answer to. You've come up with the value per share for your company, $5, $15, $35. What if the question I asked you is, how much of that value is coming from your assumptions about future growth? You see why, as an investor, you might want to care? You want to know whether $4 out of the $5 is coming from future growth or only $1. And there's actually embedded in your DCF valuation enough information for you to be able to answer that question. And here's how. If I took Goldman, Amro, and Wells Fargo, and I assume that I wake up tomorrow with zero growth forever, you know the simplest way to estimate the value of the company would be? You have dividends, right? If you have zero growth, you're going to get the same dividends every year forever. You take the present value of that perpetuity, you're going to get a value per share. You're saying, I'm going to get a really low value per share. That's what your base value is going to be. That's the value if you have zero growth. If all you assumed was stable growth, the company is a mature company, then you add a layer of growth on top of that. So you're going to add a layer. If you have high growth, there's going to be a third layer on top of it. In other words, you can take the value that you get for your company and break it up into three pieces. Assets in place, which is what you get by just taking the present dividends and treating it as a perpetuity. Value of stable growth, which you can get by using a stable growth model to value your company. And then the total value that you get from your DCF model incorporates the additional value you're getting because you have high growth for the next 5 years, the next 10 years. So I took the three companies I value. And I tried to figure out what percentage of my value in each company comes from each of the three components. I'm going to show you the breakdown, and I'd like you to think like an investor in these companies and tell me what the consequences are. I took Goldman, right? Their dividends were $1.40. I said, what if I have no growth? I'm going to get $1.40 every year forever. The value per share I have is $14.74. That's 6.6% of their overall value comes from assets in place. If I give them stable growth, add another $11.74, I'm still at $26. The total value per share I got was $222, which means 196 out of the $222 comes from my expectations about future growth. Right? They're all worth money. But as an investor, which of these three components is the most dicey? The growth, right? So when you're buying a company and the bulk of your value comes from growth expectation, I'm not saying it's a bad thing. Be prepared for surprises. And with Goldman, that surprise has been delivered, right? What have we discovered over the last 7 months? All those growth prospects we're building in our mind, and we built them up in our mind. Based on history, we're discovering might not be realistic anymore. That return on equity that we assumed they could keep doing, the reinvestment rate, we're saying might not happen. Now, hopefully, this can cut both ways. Some growth companies will wake up with positive surprises. Some will wake up with negative surprises. But here's a constant. When you invest in growth companies, be surprised for far more surprises, because a bigger chunk of your value comes from perceptions and expectations about the future, and those can change on a dime. Today, we might all wake up and say, Apple looks like a great company. There's all this talk now about a device that they're working on. Nobody's quite sure. It's supposed to be like it's supposed to be like an expanded iPod Touch. Some people are not sure whether it's going to be a netbook, whether it's going to be just a big iPod. But stock price went up $5 yesterday. It's a product that they haven't even announced. Maybe they haven't even thought about yet. It might have been completely a figment of somebody's imagination. But we just added $2.5 billion to Apple's market cap because of that rumor. It might be true. It might not be true. That's what growth assets are. Remember Amro, the value that I got was $27? The reason in 2003 I'd have been comfortable investing at that value is if you look at that value, only 22% of that value came from growth prospects. The remaining 77% would come if they were just a stable company. 77% of $27 gives me about $21. The stock was trading at $18.74. So if you came to me and said, I don't agree with you on growth, you know what? I'll concede, okay, no growth. But I still have an undervalued company. So on your company, one question you might want to take is take your company, take out all your growth, make it a stable growth company, see what you get as a value per share. If you come above the stock price with just stable growth assumptions, everything else is icing, right? Because anything you add to this will only add to the value. So it's a good exercise when you value a company. Say, let's assume no high growth, make it a stable growth company, let's see what we get as value. Any questions on breaking down value? So try it out. I'm not saying it's going to change the value of your company, but it might change the way you think about that company as an investment. Now, the next couple of valuations I'm going to show you are going to be not valuations of individual companies, but valuations of entire indices. I'm going to take the S&P 500. You know, the question I'm trying to answer is the question that you deal with every day. Is the market undervalued or overvalued, right? Is the correction over? So here's how I try to answer the question. Initially, I decided to stick with a conventional dividend discount model. I said, let me assume I buy the S&P 500 today, and all I get is dividends. It's very conservative because I'm not counting any stock buybacks. If all you do is look at dividends, in the last 12 months leading into 2009, dividends on the S&P 500 worked out to 28.05. If you go to the S&P website, you'll actually see dividends on the index going back 50 years, so you can look at this number. It was 28.05. That's across all 500 companies. I know some companies are cutting back dividends. Okay? But there are other companies that are actually announcing increased dividends. Maybe this will drop to 27, 27.5, but this is across 500 companies. All you have are a few banks cutting dividends. I can live with it. If I take those dividends and assume those dividends will grow at the same rate as earnings for the next 5 years, so you might have a dip next year, but it kind of bounces back. I get the expected dividends for the next 5 years. Beyond the 5th year, I put them into stable growth and gave the growth rate for those cash flows, which is set equal to the risk-free rate, simply because it's almost the entire economy. So I have 4 years of growth for the next 4% growth for the next 5 years, 2.21% thereafter. It's like a dividend discount model, right? I have the expected dividends expected terminal price. I discount them back at the cost of equity. And here's the nice thing about valuing the S&P 500 index. I don't have to waste any time looking for a bottom-up beta, right? The beta is 1. So I don't have to say, oh, it's the beta 1.2, 0.9. It's 1. So how do I reflect the fact that stocks are riskier today? Well, I put in a 6% risk premium. This was in January 1st, 2009. I've noticed many of you, I'm glad to see I've updated your risk premium. Many of you are using 8.2, 8.3, 8.4%, reflecting what's happened to the index since. But at that time, I used a 6% risk premium. 9% cost. In this case, if you build in, again, fix that risk-free rate. I must be carrying the same page over. So that 3.95% seems to be frozen in place there. 2.21% risk-free rate. You discount those dividends back at 8.21%. What you get as a present value is 712.46. What's the index at today? We're pretty close to that. This is the first time in 25 years that I've been able to justify the S&P 500 with just dividends. As an investor, there's good news and bad news here, right? The good news is if you're a conservative investor, you don't have to count for stock buybacks anymore. Just dividends will cover the level of the index. Okay? If you're an optimist, you say dividends are just a slice of the puzzle. I should be talking about stock buybacks as well. And if you bring stock buybacks in, you're in Fat City. You'd be loading up on the S&P 500 because if you look at dividends and stock buybacks last year, you take the 28.05, you add the 24 that you got from buybacks, you actually made 52.58 in cash flows last year. Assuming those will grow at 4%, the present value you get is 1,335. The index is, the S&P at least, if you believe the collective cash flow, with a 6% risk premium, so I've kind of updated the risk premium, is undervalued by almost 50%. This is why there's this huge tension between people who think stocks are tremendously undervalued and people who think that they're okay. Anybody who's looking at history and kind of expanding, I'd say, hey, given the cash flows, I can't justify a 730 or a 740. The counter, of course, is times have changed. Risk premium now is 8%. So the other way you can explain it is by pushing up the implied equity risk premium approach. We kept the index fixed and changed the risk premium. There is some risk premium that justifies the level of the index today. 8.5%, 9%. The question you've got to ask yourself is, do I believe risk premiums have changed this much? In which case, you live with the index where it's today. Or do I believe that this is an overreaction, in which case stocks are tremendously undervalued? Try this out. Globally, every index, you'll see the same issue. The Nikkei, the DAX, every index pretty much looks undervalued if you use any kind of risk premium that reflects history. So it could be an implied premium, but some kind of premium that reflects history and the cash flows you're getting from the index. Any questions? Basically, when you do the index, the reason it's difficult to talk about per share, the index is a weighted average, so what you see there is actually a weighted average dividend across all the companies in the index. Right? There is no per share on the S&P 500. It's an aggregate value of 700, 800. The dividends then are computed by taking the total dividends paid across the companies and weighting them using the same weights used to come up with the index. So if you ask me what exactly is this 52.58, if you bought Spiders, the actual index, that would be delivered to you as a dollar dividend. Okay? So it's kind of tough to think about it on a per share basis. It's just the aggregate index and the aggregate dividends in the index weighted by the market cap of the companies that go into the index. Any questions on David? No, I don't, because if I back it out, I get the implied premium. The implied premium will always give me the value equal to the price, right? So the implied premium, and you can see from the numbers, the only way I can end up with 740 as my present value is by using an 8.5%, 9%, which is what many of you are using as your implied premium. So the implied premium approach, rather than solving for the value, you take the value as the current price and you solve for the premium. Here I'm saying, rather than solve for today's premium, I'm asking what's a reasonable risk premium for equity markets, plugging that in and say, based on that risk premium, I think stocks are under overvalued. You can't do both. You can't solve for an implied premium and also value the index, because by definition, the implied premium is the premium that delivers the value of the index today. Okay? So it's actually, we're using the same mechanics, we're just asking a different question. Yes? It's whether you should use net. That's actually a good question. Did everybody get that question? Which should you use just the buybacks or buybacks net of new issuances? Right? It's actually buybacks net of new issuances that the S&P reports. But when you're talking about the S&P 500, new issuances dropped almost zero. It's you take the total, but let's take it and divide by the total market cap. You know how unusual it is for an S&P 500 company to make new equity issues, even in a period like last year. You take the entire issuances, it'll be 1/50th of the buybacks. But it should be the net number, but because you're focusing on 500 large market cap companies, it's unlikely to be a dominating number that's going to drive the number down below zero. Okay? So you could take all the issuances you want, net it out against the actual buybacks, you're still going to end up with a pretty substantial number. But here's the thing, is if you believe that buybacks drop to zero, you're still, based on just dividends, which is a very conservative way to think about equities, still in Fat City, right? You're pretty much at the market index right now if you want a 6% risk premium. If you could settle for a 4% risk premium, which is what we used to settle for 6 months ago, then even with just dividends, the index is at 850, 900, 950 as your value per share. So that's the S&P 500. Let's switch gears. I'm going to give you a valuation of a Chinese company. I'll give you some history. About 6 years ago, a group of Chinese central bankers came out to New York, and they asked me to talk to them about valuation. And I wanted to pick a Chinese company to value for them because they're not interested in IBM. So I went looking for a Chinese company, and I have to make a confession. I'm not that familiar with the Chinese market, and I want to avoid any company with the name China in its name, China Powered, because in a sense you're going to get an infrastructure company, boring company. So the only company I picked, and this is again another confession, that I recognize the name was Qingdao Breweries, because I've seen the name on a beer bottle. I think it was in Singapore or someplace. I said, hey, you know what, that's familiar, and there's a reason it was familiar, I'll value it. So I decided to sit down to value Qingdao Breweries, and it was actually a very interesting valuation. At the time that I valued the company, this is what the last years, I decided to do everything in Chinese yuan first. And that was, again, a currency choice. I could have done this in Hong Kong dollars. I could have done this in US dollars. I bet in Chinese yuan. The year that I looked at them, they actually had negative free cash flow equity. Their reinvestment rate was about 150%. That's not surprising, right? Growth company. There was a troubling component to their return on capital. It was 2.8%. So they were reinvesting a lot, and their return on capital looked abysmal. But part of the reason it looked abysmal is they'd built all these breweries in the last 2 years, but many of them hadn't really started to kick in. So you could see, looking down the road, that this return on capital would probably improve as the production picked up. So when I projected growth, there were two elements to the growth. The first is I assumed they would continue to reinvest in new breweries, 150%, and that the return on those new investments would average out to about 12%, which I thought was a fairly conservative estimate. I also assumed that the existing investments they have, where they're making 2.8% now, the return would drift towards 12%. 12% sounds outrageously high, but remember, this is a risky company. I'm doing the valuation in a high inflation currency. Their cost of capital is actually, or cost of equity is actually 14.71%. I'm actually not even reaching my cost of equity by year 4. I'm just moving towards it. But because I have these two components to growth, new investment growth and efficiency growth, for the next 5 years, my growth rate is going to be almost 45% a year. Do you see where that's coming from? If all they had was new investments, their growth would be about 18% a year, 1.5 times 12%. The remaining 27% that's coming each year is efficiency growth. As existing breweries kick into place, the return on equity improves on them, the growth is going to reflect that. I've noticed in many of your DCF valuations, you seem reluctant to call on efficiency growth. Some of your value companies with returns on equity of 2%, 3%, 4%, when you do your growth rate, you're locking in that return and estimating a growth rate based on the return, which might be realistic if you have a terrible company. But if you have a company where you see that return improving over time, there's going to be a second dimension to growth, which is efficiency growth. And part of what's driving the high growth here is that efficiency. By the time you get to year 5, the efficiency growth is starting to drain away. So starting in year 5, I start lowering the growth rate down to a stable growth rate of 10%. That sounds outrageously high, right? What allows me to get away with it in this valuation, that using a double-digit stable growth rate? Well, the risk-free rate when I did this was 10%. It's currency driven. What one hand gives, the other hand takes away. I give them a high growth rate and say, oh, by the way, your discount rate is also going to be high. So for the next 5 years, when I computed their cost of equity, I used a risk premium composed of a mature market premium, which at that time was 4%, and a country risk premium. Goes into a country risk, total risk premium and a cost of equity. For the next 5 years, as their efficiency growth kicks in and they're making new investments, the cost of equity is 14.71%. Notice, though, that they're a high growth company with a low beta. Generally, high growth companies often have high betas. What's it that gives them a low beta? What are the three things that determine your beta? What do you produce, right? What do they produce? Beer. How discretionary is beer? I'll leave you to answer that question. Do I need food or do I need beer? It's actually a tough choice to make, right? Oh, I could live on a six-pack all weekend. Just don't try for the long term. You'll die. But it's got hops, it's got grain, it's got all kinds of good stuff in there. I'm sure that you could survive on for a few days. Probably lots of vitamins. No proteins, I think, but no. So in a sense, what I'm trying to say is not all high growth companies have to have high betas. Because of what they do, their beta turned out to be low. But I did, in fact, adjust both the beta a little bit towards stable growth, and I also lowered the risk premium a little bit. So the cost of equity after year 5, just in the Goldman case, starts to move. And by the time you get to steady state, the cost of equity is down to 13.96%. So you can see what's driving the cash flows. It's this big reinvestment rate, but 150% reinvestment rate. In fact, any reinvestment rate more than 100% already tells you what kind of cash flows you're going to see each year, right? The cash flows are going to be negative. So the free cash flow to equity, in fact, is negative for 7 years. Not unusual for a growth company, but I took the free cash flows, I took the present value at the cost of equity. And here's what I came up with as the present value. And I'd like you to tell me, first, whether there's anything worrisome about what I found, and second, how you would explain this to somebody who's completely unfamiliar with free cash flows to equity. I took the present value free cash flows to equity over the next 10 years. The present value of the cash flows over the next 10 years is minus 187 million. In fact, what's bailing them out? The big terminal value comes in and gives them a value of 4.78 billion, which means more than 100% of today's present value comes from the terminal price. I've heard people critique discounted cash flow valuation saying 50% of your value comes from the terminal price, 60% comes from the terminal price. That's too high. What do you think those people are going to say when you show them a valuation where more than 100% comes from the terminal price? Is this a strike against discounted cash flow valuation? Is it a bad thing that more than 100% comes from the terminal value? If you bought stock in this company, are you actually going to get cash flows from the company while you hold the stock? If you think you are, you're barking up the wrong tree. This company has huge reinvestment. You're not going to see any dividends. You're not going to buy back stock. They have no cash to do any of that stuff. If you're lucky, though, you know how you're going to make money. Is the value of equity is going to drift up. You're going to make money on price appreciation. In fact, 100% of your returns are going to come from price appreciation. Discounted cash flow valuations hold up a mirror to how you actually make money on a stock. You know what I just said, right? If you have a growth company versus a mature company, expect to see a bigger portion of your present value to come from your terminal value with a growth company and a smaller portion for a mature company, because that's how we make money. But I have a mechanical question. See all these negative cash flows to equity? What exactly, how would I read this minus 52 million? What am I assuming is going to happen in year 1? There will be new equity. New equity, it's not just capital, because this is a free cash flow equity, it's new equity, which means they're going to have to issue new shares. There's going to be a dilution effect, right? So here's my practical question. You come up with the present value, in this case, of 4,596 million. What do you do to get a value per share? You divide by the number of shares, right? But I just told you that for the next 7 years, what are they going to do? Issue more shares. So when I divide by the number of shares, should I divide by the number of shares today? Or should I try to factor in the extra shares I'll be issuing because of my cash? In fact, I could probably back out now how many shares I'll have to issue in year 1, 2, 3, and divide by that total number of shares. Do you see the question? Do I divide by today's number of shares or by the expected number of shares I will have because I have to make more share issues in the future? Anthony?
I don't know how you do the expected value, so you're making an assumption on price of those shares too, right?
Absolutely.
I don't know how you do that.
But can you assume it's zero?
What's that?
I mean, you have to make, the question is,
Right,
no,
the last sale as you measure.
that's, I'm going to put the ball back there because I haven't told you what I will do yet. So I'm asking you, if you decide to reflect the number of shares, you have some practical questions, but let's, at least at the conceptual level, now forget about the practical aspects. Do you think I should be dividing by the number of shares today or the number of shares I expect outstanding? Yeah. Okay. No, in fact, that is the right answer, but here is why. Hey, because when you say this, you know what people are going to say? Well, where are you penalizing the company for the fact that they have to issue new shares in the future? Where am I penalizing them? When I did the present value, what did I do? I took the present value of negative free cash flow to equity, right? My negative, the reason I get this negative present value for the next 10 years is I've taken those 7 years of negative free cash flows to equity, and when I take that present value, it's a huge negative number. I have lowered the present value of equity by what? The present value of expected future negative free cash flow. I've actually counted in dilution, which is a wonderful thing, precisely because last thing I want to be doing there is trying to figure out what the share price will be 1 year from now, 2 years from now, 3 years from now, because that's going to put me into a circular logic problem where I will never get out of the problem. A good discounted cash flow valuation, if you've done your job right, if you've done free cash flow equity, the value of equity today already reflects expected dilution coming from future stock issues, or future equity issues through the free cash flow equity. That's the nice thing about doing free cash flow equity. If I did a dividend discount model, then I could have trouble, right? Because there I can't have a dividend below zero. So if I truly have negative cash flows and I'm issuing shares, then all bets are off, and I'm going to put it back in your lap and say, why did you do dividends in the first place? But with banks, this is something I think we have to worry about with dividend discount models, because as you pointed out, many banks are issuing shares now to cover capital. And a traditional dividend discount model doesn't build it in because there are no negative dividends. I mean, unlike a cash flow model. But in a free cash flow model, you've already built in future stock issues through the present value of the cash flows. There's nothing you need to do beyond this. It's already in there. Which means all you have to do is divide the 4,596 by the actual number of shares today, and you should get a fair measure of what the value of equity is per share today. Yes, Louis? Banks, you have to. Do you see why, though? What allowed me to capture the future stock issues? The fact that I brought in the negative free cash flow equity year 1, year 2, year 3, year 4. But to the bank, because I'm using a dividend discount model, dividends can't be less than 0. And because dividends can't be less than 0, there's no easy way for me to reflect the fact that more capital has to be raised. So it is with the bank. If you feel the way they will have to get the additional capital is by issuing more shares, you will have to factor in the number of shares. My suggestion is use today's, in a sense, make it at least reasonable for you by acting like all the equity is raised today. Because if you assume it's going to be raised over time, then you're going to have issues of what will this price be 1 year from now, 2 years from now, 3 years from now. Okay? So that's, I think, a factor to consider when you use a dividend discount model. Any questions? We're going to do a few emerging market company valuations. I'm going to start with Aracruz, right? Paper and pulp company. And the reason I picked Aracruz is the biggest driver of Aracruz's earnings on a year-to-year basis is not how efficiently they run, but what the price of pulp is. I mean, I know that we don't follow the price of pulp as much as we follow the price of oil. But every commodity price goes through cycles. Okay? And if you look at the price of pulp, you see that last column there? And you look at what Aracruz's earnings have done. You can see very quickly that if you look at the price of pulp, you can almost jump to what their earnings look like that year. When the pulp price goes down, earnings go down. Pulp price goes up, earnings go up. Here's why it matters. I'm valuing Aracruz in 2001. The company's just had a really good year. You know why? Because the price of pulp had hit a 10-year high, 109.39. The earnings they reported was $666 million, based on the price of pulp in 2000. You can already see what's going to happen. If I take that as my base year, the 2000 numbers, here are the things I'm going to find. They made a lot of money. The return on capital looks really good. And if I then build that into the future, I'm going to find that the stock is tremendously undervalued because, in effect, I've built in the high price of pulp. I've taken a high point in the cycle, and I've made that my basis. You're going to find this with almost every oil company value right now, right? Because you're going to take 2008 numbers. You're going to build those 2008 numbers in. Everything's going to be affected by those numbers. So what's a common sense solution? We know we move through cycles, right? We don't want to take the top point in a cycle or the bottom point in a cycle and build a valuation of it. So we want to somehow kind of find a middle point. I know this is simplistic, but here's how I did it. I took the 10 years of pulp prices, and I could have gone back further because pulp has been traded forever. I could go back 35 years. Just be careful. The further back you go, the more you have to worry about inflation adjustments to your own price because currencies do devalue over time. I took the average price over those 10 years, 102.58. So I said, I'm going to treat that as my normalized price for pulp. You see what the next step is? I see how many tons of pulp are produced. I multiply it by my normalized price, which brings down my revenues. You trace it through with the fixed cost. Their operating income, instead of being 666 million, drops to 304 million. You say, why such a huge drop? Because if you have a lot of fixed costs, small changes in revenues translate into big changes in operating income. What's the analogy with oil companies? To value an oil company now, you have to first then decide what a normalized oil price is. You might say, well, it's already been normalized for me, right? Because you can say it's at 46, that's what I think it is. But you then have to feed that price in, come up with expected cash flows. You either do this or you go to the forward market, look up the prices, use that, but then you have to decide how much production you will have per year. But there is no way you can value a commodity company without taking a point of view about where you are in the cycle into that valuation. So this entire Aracruz valuation is based not on the 2000 numbers, which I think are inflated because pulp prices are high, but based on the numbers I obtained with my normalized pulp. Let's suppose I'm really worried about the pulp price actually getting to this. How would I hedge? So let's say I come up with the value per share. Okay? The value per share I come up with is 2.75 billion. The stock is trading at 3.5 billion. Obviously here, I'm finding the stock to be overvalued. But let's say I found it undervalued. But I'm really worried about this pulp price assumption I made. Is there a way I can make a bet on my company valuation and hedge myself against the mistakes I've made on the commodity price? Sure. I mean, that you have commodity price futures and options. If you're really worried about your bets on the commodity price being wrong, here's what I'd suggest. Value a company, come up with a value per share. If you think it's a good company, buy the company, and then protect yourself against the commodity price moving all over the place by using the futures market. You might regret what you did, right? Why? Because if the commodity price shoots up, you're going to lose the upside. Hey, but you can't have your cake and eat it too. If you want to hedge, then you give up some upside, and that's basically it. If you really want to keep the upside, here's what I'd suggest. Instead of buying futures, buy options. That's really the question of which one do I use. Is you want to preserve some of the upside, pay a price up front. It will cost you more up front, but at least you get some of that upside. Yeah. But with commodities, there's different things can happen. You can have depending on where you are in the cycle. You could see, for instance, oil prices 2 years ago at a downward sloping cycle. Now they're starting to go. So basically, the commodities market is saying prices will probably drift back up. You can build those expected prices into your valuation then, and then hedge against the risk again using those same prices as your hedging mechanism. Okay. Yes. Yeah. Yeah, in this case, the reason I did not adjust for inflation, I was doing things in dollar terms. The inflation rate was like 1.5. Do you see what the adjustment for inflation would involve? If there's 2% inflation over time, if I give you the average oil price over the last 30 years, that's a little misleading because that price is going to be too low. I'm taking absolute prices. What you then do is take that average price, which is kind of at the midpoint of your 30-year period, and then look at 15 years of inflation. Not in that commodity, but in the overall currency. Okay? It is probably more accurate to take an inflation-adjusted price, but the best way to answer it is look at your cycles. You have a commodity price cycle, right? See if, in fact, the commodity price cycle reverts back to an absolute value. Gold, for instance, often you revert back to that, or whether it reverts back to an inflation-adjusted. So use the data to answer that question. Right? Any other questions? Yes? that. Make your judgment. Basically, so basically again, let the data tell you, right? Because as you look at the cycles, you will get a sense of how long the cycles last. The problem with cycles is they can kind of vary from 3 to 12 years. But once you made that judgment, you might say, I want to go back to that period because that's what I think a typical cycle is over. Yeah. I wouldn't worry about it. Best way to deal with that is when you put in a country risk premium. You worry, see, because the minute you start opening the cash flow up to that, it's kind of a never-ending problem, right? So when you do this, say, look, I'm going to do the cash flows. When I get to the discount rate, the fact that it's a Brazilian paper and pulp company is going to enter into my discount rate. Let the discount rate take care of the uncertainty. Yes?
How did you find the fixed costs? Were they disclosed in the financial statement?
Do they have to, though? I mean, look at the cost structure over time. I mean, at least you can get a sense of,
like
back engineering the fixed cost, right? Of course, you have a problem if your commodity company's been around only 1 year, but generally, if you have a time series of data, you can pretty much back out the fixed and variable costs. Now, here's a question that you're going to run into in every free cash flow to the firm valuation, right? When I did the cost of capital for our accrues, here's what I did. I took the market value of equity and the market value of debt to come up with the weights for the cost of capital, which is what we're always supposed to do, right? So I followed the rules. I took the stock price, times share price, market. The market value of equity for our accrues at the time that I did this valuation was $3.5 billion. So that's what I plugged in when I did my cost of capital. I used that cost of capital to value our accrues. And at the end of the valuation, what did I tell you? The value of equity is $2.75 billion. As I said, I mean, that's going to be true in any free cash flow to the firm valuation. The weights you use for your cost of capital are not going to be the same numbers you arrive at the end of the process as the values for equity and debt. Now, this actually drives quantitative people crazy. And here's why. It's the equivalent of you doing a math problem, where you start the problem by saying, let x be equal to 3, y be equal to 2. And at the end of the problem, proving to me that x is equal to 2.5 and y is equal to 3.1. No math professor would ever let you do it, right? You can't state a fact up at the start of the problem, and the end of the problem, say the fact is wrong. But we do this all the time in valuation. And I gave you the justification we use. At the first stage in the process, and I think I did several weeks ago, you might have forgotten, when we do the cost of capital, we use market value weights. You know what our justification is, right? If I went and bought this company today in the marketplace, this is what I have to pay. It's not what I think the company is worth, it's what the market is charging. So I might think the company is worth only $2.75 billion, but if the market price is $3.5 billion, that's what they'll sell it to me for. So the argument with publicly traded companies, at least, is the reason we use market value weights that are at variance with our own estimates is that's what we have to pay to buy the company. And what we're claiming at the end of the valuation is our own idiosyncratic view of what the value of this company is. Now, this will convince about 90% of engineers. The other 10% will be holdouts. I don't like this. So let's say you have a managing director who really hates this. He can't stand it. He's going to fire you if you keep doing this. So your incentive to do something about this is very high. Is there a way we can make our discounted cash flow valuations internally consistent? You see what I'm trying to say? Is there a way in which I can use numbers in my cost of capital which actually reflect what I come up with as numbers at the end of the process? You see, the standard problem you're going to run into is you don't know what the numbers are when you do the cost of capital. You're saying, this is circular, what do I do? Nice thing about the iteration box in Excel is you can make the weights in your cost of capital your own estimated values for equity and debt. The only problem is if you don't check the iteration box, Excel will go crazy on you. It'll start drawing lines between the cells, saying circular reasoning, the whole spreadsheet will start coming apart. But if you set the iteration box, it'll actually use your estimates of equity and debt as weights in the cost of capital. You know why this is going to be particularly useful? If you have to value a private company, you have to value an IPO. You don't have the luxury of market value, right? But you can't use book value weights. So when we value private companies, this is one of the techniques we will use to come up with the weights for the cost of capital. We will use our own estimates of equity and debt from our discounted cash flow valuation as weights to come up with the cost of capital weights to value the company. So I don't lose any sleep over this inconsistency. Some of you might, in which case you're very sick. But if you lose sleep over this inconsistency, there's a way around it. Set the iteration box, move on. Life is too short for this to be the holdup in doing discounted cash flow valuation. So we talked about Aracruz, Brazilian paper and pulp company. Let me move on to a company called Tube Investments. It's a family group. This is actually it's very much like any of the family groups you see in Asia. A company that's in multiple businesses. It's a company that actually grew around the city where I grew up in. So I know a lot of the people involved in this company and I've known them for a long time. So about 5 or 6 years ago when I was down and visiting my parents, this was one of those missions I was given, is come into the company and talk about valuation. But they actually had a very specific reason they wanted me to do this. Their stock price was at about 102 rupees per share, which is about 4.5 times earnings. And they felt they were being seriously undervalued. So what they wanted me to do is come in and tell them that they were right. So I decided, okay, I'll take a look at your company and I'll value it. And I put up this valuation and they were shocked. And the reason is, I thought actually the 102 was being too generous and that they should really be valued at 62. So here's the first question they asked me, and you are now in a position to be able to answer this question. You know enough valuation to be able to do this. First question I ask is, why is our value so low? Which input in my valuation is destroying value? Return on capital. Oh, that's pretty good, I thought, 9.2%. For a U.S. company in a mature market, 9.2% is great, but when your cost of capital is 17%, and your return on capital is 9.2%, you're destroying value. That's one leg that's destroying value. You know what the other leg is? They're not stopping. Not only is the return on capital lower than the cost of capital, it's almost like they're self-destructive. They keep doing this year after year. And the way they've been doing this, I think they will do it forever. Look at the return on capital I've given them in stable growth. What's destroying value is the assumption I'm essentially making in this valuation. And I'm making this assumption not based on their own behavior. They've been doing this for 5, 6, 7 years leading into this valuation, going out and making a lot of investments, earning well below the cost of capital, justifying it on some strategic basis or something else. So, of course, after I presented this, they started looking for the standard ways. Is there something we can change in this valuation which will make the value go up? Here's the first ploy they tried. See this growth rate I've given them in stable growth, 5%? Well below the rupee risk-free rate at that time, right? So here's the first question that one of the managers asked me. He said, you're being too conservative with this 5% growth rate. I'd like you to use 7%. I said, this is wonderful. I'll use 7%. That's good, right? That should push up value. In this case, though, when I increase the growth rate, what do you think is going to happen to my value? Their return on capital forever is 12%, well below, or 9%, well below their cost of capital. I increased the growth rate, the value went down to 55, which kind of cut off that entire line of questioning right there, because they knew if they pushed to 9%, 10%, this was just going to, when you're destroying value, destroying even more value each year is not a great way to do it, right? So then they came back to reality. They said, okay, what do we need to do to get the value up? Okay, advise them. They can try to finagle the cost of capital, better mix of debt and equity, right? But when your cost of risk-free rate is already 12%, you can see that there's going to be a floor on that cost of capital around 15.5%. There's only so much the cost of capital can do. So I said, hey, the only way you can increase your value is by taking better investments and improving the return on your existing investments, which is the easier half of that question, the easier part of that. The better investments you can choose to do, choose not to do, so that's fine. You can make it 0. The existing investments, these are mistakes you've already made. Fixing those mistakes is going to take time. So here's the first round I did for them. I said, let's assume that all you do is fix the new investments you take, and you take only good investments. Okay? I'm going to be generous to you and assume that your reinvestment rate will stay at 60%. The reason that's generous, if you're taking better investments, odds are you find fewer investments. I said, let's say find the same investment. I'm not going to ask for miracles. I'm going to assume that you move towards your cost of capital, but not all the way there. In other words, I'm not even asking them to take positive net present value projects. I'm asking them to take less negative net present value projects. So the 12.2% is still lower than the 16.9%, but at least you're moving towards your cost of capital. That's the only change I made. Holding everything else constant, the value goes from 61 to 84 rupees. Still not at 102, but we're moving in the right direction. I said, okay, on top of this, let's layer the second change. In addition to taking good investments on the new investment, let's assume you could improve the return on your existing investments. You see what this is going to do for you, right? If you improve your return on existing investments from 9.2 to 12.2%, in addition to the growth you get from new investments, you're going to get that efficiency growth. Which means for the next 5 years, you're going to get a much healthier growth rate, partially because your existing investments are moving up. With those changes put in, you get 111. I left them there because they can already see that if they could move their return on capital all the way up to 16.9%, the changes, the value per share goes to 200 rupees per share, 220 rupees per share. But it kind of tells them where they need to focus. It's not on, see, what got them into trouble was a focus on growth. They thought if we grow faster, we should be worth more. The flaw in that reasoning is it's not just how fast you grow, but how well you grow that drives value. So they bought a lot of growth, they paid too much for that growth, and what they're seeing is a stock price going in the wrong direction. Yes?
Why should you embed that on your valuation, like that bid or offer a price that doesn't include that?
Or somewhere in the middle, right? If you think there's a probability of this happening, because the question you're asking is, as an investor, should I pay 61, 84, or 110? If I had a choice, I'd like to get it at 61. Odds are that I'll have to pay some expected value, but where I will end up in the middle will depend on the probabilities attached to each of those three scenarios. Okay? And this is why I think corporate governance should always be an issue in valuation. What have I assumed about Tube Investments? That not only will it take bad investments next year, 2 years out, but that they will keep doing this forever, right? If you have a good corporate governance system, what would you do with the managers of this company? If they're destroying value, they keep destroying value, at some point you're going to step in and say, you guys are awful, you're out of the door, right? You're saying, why isn't this happening in this valuation? This is a family group company. It's run by the family. They might not own enough stock, but they control the company intensely enough that there's nothing you can do. Sometimes you hear people say, should I be discounting the value I get for the fact that this company is in Indonesia or in Brazil or India and the corporate governance is weak? And my answer is, you probably already did. And you know how you did it? When you value this company, if you set the return on capital below the cost of capital, because that's what they've done, and you allow this to continue in the long term, you've effectively built in the absence of strong corporate governance into that valuation. In fact, if corporate governance systems improve dramatically in countries like this, you can already see the payoff, right? If corporate governance systems improve and you think bad managers are going to be replaced much more quickly, the values of companies in these markets should jump. And the values of the worst managed companies should jump the most, because that's where the payoff to having a better corporate governance system is going to be highest. In fact, there have been studies that have looked at countries which have changed corporate governance laws to make them stronger. And they look at the impact on the stock price. They get this jump in the stock price, but the jump is disproportionate. The worst managed companies would jump the most, because that's where the potential for change is greatest, and the best managed companies jump the least. So if you've done it right, it should already be in there. Louis?
Explaining the control premium.
Exactly. It's one aspect of the control premium. Right? So in fact, did everybody get this question? We talk about the control premium. What's a control premium? You look at a company like Tube Investments, and what do you say? If I ran that company, I would do things a lot better. In fact, all you'd need to do is stop investing and your value will go up 20 rupees. How difficult is that to do? Which means that when you invest in companies like this, you might take the value per share and pay a premium on it because you think you can run the company better. So when we talk about the expected value of control, that's exactly what we're going to do. We're going to value the company's status quo, we're going to value it run optimally, then we're going to ask what is the chance you can take it over, and that's going to tell us what the control premium should be for a company. Yes. Yep. It was actually last year was over 100%. I lowered it to 60% because I wanted to kind of be nice to them. That came the growth rate in terminal value is a computed number, right? The way I compute the reinvestment rate in the terminal value is I take your growth rate and I divide by your return on capital. What extra cash? You're taking the cash out, right? The free cash flow, whenever you discount free cash flow to the firm, what are you doing? You're taking whatever cash is not reinvested, you're acting like you're taking it out of the firm. So whenever you do a firm valuation, there is no excess cash building up in the firm because you've acted like you've taken the cash out. Now, they might choose not to pay the cash out and accumulate in the firm, but you can't count that cash because if you count that cash on top of the present value, you've actually double counted the cash. You've acted like you took the cash out each year and you've let the cash build up in the firm at the same time. So whenever we take the present value free cash flow, we're acting like any cash that's not reinvested is effectively taken out of the firm. The end of year 1, end of year 2, end of year 3. Okay? If you do that, then you know what you have to do? You have to put 0 in your cash flows. You can't put in the free cash flow, discount it back, and add in the dividends because you're double counting the same cash. So if you want to do a dividend discount model, you might say 0 dividends, 0 dividends, 0 dividends, big dividend in year 4. But that's an alternative. You're switching back to a dividend discount model rather than a free cash flow to the firm model. You could use that as an alternative. Maybe that's another way they're destroying value, is by holding back cash and delaying the return of cash to you as an investor. Okay? Now the next valuation I'm going to do is a valuation of Embraer, and I'm actually going to show you 2 valuations at different points in time to show you the effect of country risk. Remember, Embraer was a company that I used to illustrate lambdas. I used it to show that the lambda was low, right? Because it has less of its revenues in Brazil. And in fact, if you look at the valuation of Embraer, the way it shows up is when I do my cost of equity, I did my valuation in US dollars. I start with the risk-free rate. I take the beta times the mature market premium, and then I take a lambda, reflecting the fact that it is less exposed to country risk, and came up with a cost of equity of 10.5%. This was in October of 2003 when Brazilian country risk was still very high. So in this case, having a low lambda helped me out with Embraer because it lowered their discount rate and allowed me to come up with a higher present value. In fact, the value that I came up with was 21.75 reais. The stock was trading at 15.5. But the reason I'm coming up with such a high value is not because my estimates of growth and cash flows are much higher than everybody else. It's because my estimate of the discount rate is lower than most other people looking at Embraer. In fact, as I said, lambda is a very idiosyncratic measure that I concocted to capture country risk, and most people don't even see lambdas. They just basically take the entire country risk and add it on. So here's a pragmatic question. Let's say you get out of this class, you decide to use the lambda approach. You take a company like Embraer, you plug in this low lambda, you come up with a low discount rate, you come up with a high value. Everybody else in the world goes their own way. Let's make this start. They take the entire Brazilian country risk, they put it into the discount rate, they'd come up with a much higher discount rate, they come up with a lower value. So they come up with a 15.5 real value, they say Embraer is fairly valued. You say, no, I think Embraer is undervalued. So what should you do? You could buy it at 15.5 and then do what? Then preach lambda to the rest of the market as if anybody will listen to you, right? You can try it. I mean, there's no harm trying, but I'll predict that your talking about lambda is not going to make the stock price go up to 21.75. So you want something else to remind investors about the true risk in this company, right? You can't do it. You can't talk to them about it. But you know what that something else is going to be? Embraer is a continuing company. It's going to report earnings, right? Quarter after quarter. Brazil is going to go up and down over those quarters. If you're right about the lambda being low, and we saw this when we did the lambda discussion, what should you see Embraer's earnings do as Brazil goes throughout its manic depressive phases? It should be pretty stable. Even if not constant, it should have nothing to do with Brazil. What you're hoping for, and there's no guarantee here, is at some point in time after the 6th quarter in a row, when Embraer has come out with these nice, predictable earnings, people will wake up and say, hey, we've been unfair to Embraer. Can I guarantee it will happen? Of course not. But that's what you're hoping, and that's what's not in your control. It might never happen. You could go to the grave being right and bankrupt. Right? But that's the nature of equity investing. What I'm trying to say is there are consequences. When you're doing I think this is the right thing to do, but if you're the only person doing it right, it might take a while for the rest of the market to get there, and the only way they get there is they get some external stimuli telling them, hey, you did this wrong. Is a low lambda a good thing or a bad thing? It depends on whether country risk is going up or going down. 2003, it worked in your favor, right? Between 2003 and 2007, remember we saw Brazilian country risk premiums coming down? So you bought Embraer because it was less exposed to country risk, right? You congratulated yourself for doing that. Brazilian country risk starts to come down. Brazilian equities start to bounce back. But if Embraer is not benefiting from country risk, you actually bought the wrong stock at the wrong time. In fact, last year, 2008, when I valued Embraer, I was in Brazil again, value per share dropped to 15.72. The same thing that made Embraer such an attractive investment as Brazil became a riskier country, became a very unattractive component as Brazil became a safer country. Now, I should do a valuation this year, because what's happened to Brazilian country risk between 2008 and 2009? It's gone up. In fact, my guess is that if you bought Embraer at the low point last year, you were in a much better position to take advantage of that low lambda, because country risk is now starting to go up again. And this is exactly the kind of stock you want to own as country risk goes up. So what I'm trying to say is low lambdas by themselves are neither good nor bad. You're making a bet on country risk with low lambdas. Just make sure you make the right bet at the right time. Okay, please.
Forecast revenues by country for Embraer?
They do, but they discount them all back at that 18% cost of equity. They don't discount each country's revenues at a cost of equity appropriate to that country. They apply one cost of equity across the board because Embraer is a Brazilian company. That's where you and they will part ways, because they're applying an 18% cost of equity, saying Embraer is a Brazilian company. It doesn't matter where the revenues are coming from. We're going to discount those earnings back at the 18% cost of equity. So even if you agree on the revenues, they're going to end up with a lower value for Embraer than you will, right? Yes? Right? I think, well, you know what Embraer's problem is? We're its clients. Airlines. When your clients are all in the basket cases, it's tough to be prosperous. I mean, the only way airlines, aircraft companies like Boeing and Embraer stay afloat is they're giving credit like crazy to the airlines. They're saying, here, take the plane. You don't have to pay me for the next 35 years. Okay? That's the only way. I mean, because you look at their potential customers. It used to be that Asian airlines were in good enough shape to buy aircraft. Even they've stopped buying. So the problem for Embraer is it's not so much a country risk issue anymore. They're serving the wrong business. And because your customer is in such bad shape, it's starting to reflect back on Embraer. So that bet is a different bet. So that's a different issue that's overlaying Embraer. But that's built into the earnings and cash flows. My guess is we're agreeing on lower earnings and cash flows because of that. The question is, what is the effect on discount rates now of this added Brazilian country risk? And there you're still going to get a deviation between analysts. Okay? Yes? I'd say make your own judgment, right? So, because the question you're asking is not about did country risk go up over the last year. What is it going to depend on? Is do you think Brazilian country risk will go up over the next year or drop over the next year, right? So I don't know what you think, but I think it's going to drop, so I'll buy Embraer. But I will not suggest that as my recommendation to you, because you got to make your own judgment. This is not a company judgment as much as a country risk judgment that's going to drive my investment. Yeah.
Like independently from the cyclicality, you could basically go along the company short the index, right? So
You could. Yeah, there are ways. That's actually a good point. It's like commodity companies. If you think Embraer is a good company and you're worried about country risk as a separate issue, you could go short the index, or you could go short the dollar-denominated bond, or some other more direct measure of country risk, and see if you can hedge it. So take advantage of the fact that you have multiple securities, multiple ways of being exposed to market risk, and protect yourself against those risks that bother you the most. Hyundai Heavy, Korean company, June of 2008. I was actually first time I've ever been in Korea. I did a valuation and did a valuation Hyundai Heavy. Much of it is very conventional. It's a manufacturing company, astoundingly high return on capital. I don't even know what accounting games are. I didn't even want to look. Right? But it looks like they make a tremendous return on capital. Interesting thing is they have a pretty low lambda because they get a lot of their revenues outside Korea. Though I did close my eyes to where they were getting those revenues. You know where they're getting the revenues, right? They're actually not getting in the US. They're getting in China. They're getting in Thailand. And the reason I closed my eyes is I didn't even want to think about what this means in terms of lambdas. Because if I were doing this right, I should have a lambda for Korea that's really low, but then I should whack them with a lambda for China and a lambda for Thailand. But I was too lazy. I had like 2 days to do the valuation. I said, lambda for Korea, let's move on. Right. Yep. Well, if you ignore lambda, then you're going to add the entire 1.2%. Ignoring lambda is not going to do that, right?
If it's all from China and
It's not all. It's like there's a lambda of 0.06 against China. If 60% of the revenues had come from China, I couldn't have done this. They get like 6% from China, 4% from Indonesia. They still get about 60% from developed markets, but it's not. I mean, so if that proportion had been reversed, I couldn't have done this. So I did the traditional valuation, but here's the part of the valuation I want to focus on. Hyundai Heavy is part of the Hyundai family. So I did the present value of cash flows, I added the cash, and then I looked around and I saw they had 7 big holdings in other Korean companies. Here's what their holdings look like. These are notice they all have the Hyundai prefix on them, so these are all holdings in other companies, cross holdings. They're all minority holdings. I haven't valued any of them yet. How do I know? Because what did I use as my starting point? Operating income. These are minority holdings, so all the income from this shows up below. I cheated on the 4 public holdings. You know how I cheated, right? In theory, what should I have done? I should have gone and looked up the financials in each of these companies, done a full-fledged valuation of each company, looked at the percentage. Too lazy to do that. I said, public, there's a market price, I'll take them. So what do you see as the value of the holding? There's just the market value of the holding. For the 3 private holdings, I couldn't even cheat. But I did have a book value for these holdings from the balance sheet. I also knew what businesses these holdings were in. So I applied a price-to-book ratio based on publicly traded companies in emerging markets in each of these businesses. See the 1.1? That's actually the typical multiple of book value that financial service companies were trading at then. I multiplied the book value in Hyundai Oil Bank by that ratio to come up with an expected market value. So I'm actually building up in 2 steps. In public companies, I'm taking the market value. The private companies, I'm estimating a market value using the multiple. The sum of those numbers that I got was 3.937 billion. If you go back to the previous page, that's my value for the cross holdings. Then I thank the Lord that I wasn't doing the Japanese company with 227 cross holdings, because this process alone would have sucked up the rest of my life. What I'm trying to say is those of you valuing companies that are part of family groups, watch out for this item. 30%, 25%. And I'll tell you what can happen when you forget is about maybe 3 or 4 years ago, I valued a Tata company called Tata Chemicals. And I came up with a value of 120 rupees per share. The stock was trading at 180. So this was in India. I make the presentation. And then one guy was from Tata put up his hand and he says, "You've forgotten something fairly critical." And I said, "What have I forgotten?" He said, "Well, Tata Chemicals has a cross holdings in Tata Consulting Services." Now, for those of you not familiar with Tata Consulting, it's one of the largest market cap companies in India right now. But at that time, it was not publicly traded. It was privately held by the Tata family. So I'm saying, well, look at it, 5% of Tata Consulting Services. What could that mean? That alone was worth 100 rupees per share. My 120 rupees per share completely ignored the fact that half their value came from this cross-holding in one other Tata company, which happened to be an extraordinarily valuable company. And the problem was, in their book value, you're saying, how come I missed it? The book value, it was such a tiny number because they were reflected at the original amount that the investment was made, which was like 35 years ago or 30 years ago, that he would miss it. So I'm saying be cautious with companies that are part of family groups, because you can get this, what you think is a small slice being worth a lot of money because of that cross-holding. So that was the key issue here, is what to do about that cross-holdings. And I mean, that's what the rest of the valuation is pretty much what we've done with any other company we've valued. Any questions on cross-holdings? Yes?
Now, here, I mean, the earlier company, you actually penalize them because you had low IRR and poor growth and things like that. How are you penalizing this company?
Why would I penalize them? They're making a great return on capital, right?
The point is that, I mean, they've got a very poor corporate governance.
That's a different issue. The way you'd penalize them is, see this, the part which worries me is this brown paper bag they're holding with the non-operating assets, right? The rest of the company I can value, because it's a traditional shipbuilding company. I don't have a problem with any of the stuff there with the shipbuilding company. What bothers me is what's in the brown paper bag. And you're right, there is that $3.9 billion value that I'm attaching to it. And you say, well, how do you know? These are 7 businesses they've invested in. You haven't taken a close look at any of the 7. It might be worth only $1.5 billion. It might be worth nothing. Okay? That's a fair enough point. If you are concerned about cross-holdings and you feel that there isn't, in this case there were 7 big cross holdings, and you could see the financials of the company, so I could at least see what was, and since they were public, you could pull up the information. But if these had been 7 private businesses, and they'd held back on the information on revenues and operating income and the cash flows, I'd have said, you know what, you could tell me they're worth a lot, but I can't see what's in the bag. I'm going to put a value of 0 and see what they come back with. Okay? So in this case, the way you would penalize them is by knocking down the cross holdings so they come out with more information to convince you that it's actually worth money.
And the second thing is that, we probably, this one we assume 34% return on capital, but probably it must have been in a good year of shipping.
No, actually they've had a history of 36, 37. There's something they do, I think, accounting-wise that's making the return high. I'm not sure what it is. I don't know enough Korean accounting to even go there. Right? There's something weird about the return on capital, and it did bother me. So I've kind of, if there's a big question, if I were doing this for the company, the big question I would have is I want to see the insides of what goes into your book capital and why it's so low. It's not that the operating income is high, it's the book capital is so low. What are you doing? Are you leasing stuff and not showing it as part of capital invested? Something is going on here that we're not catching. So that, I think, would be an issue if I were valuing the companies. But even here, in stable growth, guess what? I push the return on capital down to the cost of capital rather than leave it at the 30% I see right now, because in steady state, I don't see the potential competitive edge you're going to have that's going to allow me to earn more than my cost of capital essentially forever. Luis? Yep.
Like with the Hyundai Old Bank, or
Yeah.
the way you calculate, I guess, is book value multiplied by the multiple.
Yeah, basically I take the book value and I multiply by 1.1, so there's my estimated 362.78 is 329.8 times 1.1. So you see that?
Like they have 20% of that.
They have 20% of that, yeah.
So total market cap should be the multiplication of the last quarter.
Exactly. The market cap should be the multiplication of the total book value of that company. That's just my book value in that company, right? So this is not the total book value of Hyundai Oil Bank. This is the book value of Hyundai Heavy's investment oil bank, which is only 19.8. So that's actually 19.87% of their total book value. Okay. One way actually I frame this dark side evaluation, the new edition I'm doing, is I argue that there are valuation challenges at pretty much every stage in the life cycle. Those valuation challenges tend to be highest early in the life cycle. Okay. Think of why. I come to you with a really young company. I'm not even talking about a really young company, an idea company, and I ask you to value the company. It's a lot more difficult to value a company like that than a company later in the life cycle. In fact, what I've done here is essentially I've listed out the potential challenges you face at each stage in the life cycle. With young companies, the question I ask is, what is the potential? You don't even know what the market is. What market share? Everything is up in the air. So your big issues are getting revenues, getting market share, getting expected earnings from nothing. As you move down the life cycle, the challenges don't go away. They just become different. With mature companies, the challenge might be, the company be restructured? Can they sell off assets? With declining companies, the challenge might be, how will I know that this company will survive? So essentially, my point is, it's not that you don't have challenges at each stage in this life cycle, but the type of challenge you face will be different at each stage. So as the last part of this particular session, I want to talk about valuing young companies and what makes it so difficult to value young companies. So you're a venture capitalist. Every company that comes to you is a young company. What are the potential challenges? Here are some of the issues. First is there are either no past revenues because your company has never sold an item, or the past revenues are tiny. That's the first problem. Second, often the operating income that goes with those revenues is a big negative number because you really haven't started generating. So if you look at last year's financials, you see small revenues and big operating losses. When you try to project growth, you can't use return on capital times reinvestment rate because they're both negative numbers. There's not a whole lot of history for you to make that judgment. When it comes to cost of capital, there's often not enough data to estimate a beta or a rating. And if you try to use synthetic ratings, guess what problem you run into? You need an interest coverage ratio, right? Operating income divided by interest expense. If you have a young company, operating income is a negative number, you're in the hole. So door after door you're going to open and shut saying, that didn't work, that didn't work, that didn't work. And finally, after you value the equity, do not be surprised with young companies to see multiple claims on the equity. You got venture capital stage 1, stage 2, stage 3, different characters. In other words, you can't just say 1,000 shares, they all look alike, because the first 100 shares might get very different powers than the next 100 and the next 100. So life's a lot messier with young companies. So here's the question we face. How do we value young companies especially when everything seems to be going against you. In fact, let's step back. What are the 3 places you go to get information about your company? You look at the current financials, you look at past history, and you look at the rest of the sector, right? One by one, let me knock your crutches out. Let's assume you're valuing a young company. Which of the 3 do you not have? No history, right? It's a young company early in the life cycle, so the current financials tell you very little about the company. And you look around, every company in the sector looks just like your company. They're all young companies early in the life cycle. You're in the nightmare zone in valuation, right? This is when you're going to be tempted to go over to the dark side. You know what the dark side is, right? What's the sector that I just described? 10 years ago, you're the dot-com sector, right? They're all young companies, all losing money. Every company in the sector looked just like yours. And what was the dark side there? You said the old rules about valuation don't matter. Things like making money, vastly overrated. You started coming up with multiples that nobody had ever seen before. Market value per website visitor, market value per eyeball. Heard of that? Mary Meeker divided the market value of companies by the number of minutes people were looking at a website, as if we could suck revenues out of their eyeballs. That's the dark side. In fact, when I used to do these valuation sessions in the late 90s, at the end of the session, people would come up to me very aggressively say, "You cannot value Amazon.com using a DCF model, can you?" And the finger would be going like this. He's saying, "Please, don't invade my private space here." And at the risk of grave personal injury, I'd say, no, I think you can value Amazon using a DCF model. They'd give me this look of total contempt. Academic, and they'd walk away. Now, academic in their vocabulary is not a compliment. Basically, it means, hey, you really don't have to value companies for a living. You just say you can value companies. You really couldn't do it. I finally got so pissed off that I said, you know what? I'm going to actually sit down and value Amazon using a discounted cash flow model. I did it for the first time in '98. And while I was doing the valuation, I kept a journal on every frustration and roadblock I ran into and how I tried to get around it. To give you a sense of how many roadblocks I ran into, the journal, by the time I was done valuing Amazon, was 75 pages long. So I said, I've written it already. Why should I waste it? I called it the dark side of valuation. Can Amazon.com be valued, and put it on my website. I dump everything on my website, whether people read it or not. Just put it there. That was what became the dark side of valuation, the first book. That 75 pages grew out. In fact, it doesn't take a rocket scientist to figure out how to value a young company, right? Help me out. They have small revenues and big operating losses, right? Can a company with small revenues and big operating losses become a valuable company? Help me out. What has to happen to the small revenues? Got to become big revenue. Let's be simplistic, but let's stick with it. Small revenues will become big revenues, right? What has to happen to the operating losses? They become operating profits. Oh, this is simple. So all I need, the 2 key inputs in valuing young companies are revenue growth to make small revenues into big revenues, and a target margin. Those of you who use my high growth spreadsheet have seen basically these are the 2 numbers that drive it. But I'm a great believer in consistency. To make small revenues into big revenues, you need to be willing to spend some money, right? In fact, that's the roadblock I ran into the longest time on. Right? How do you estimate reinvestment for a company if all you have are revenues and operating losses? And here's the ratio I ended up using. So remember, we did this for Sirius. You give me the sales to capital ratio. I'll estimate how much you have to reinvest to get a change in revenues. So when you see the valuation of young companies, that is basically the technique I'm going to use. I'm going to take small revenues and make them big. I'm going to make negative margins to positive margins. I'm going to estimate how much you need to reinvest. And then I'm going to be careful and ask a final question. What happens to most young companies? They don't survive. In fact, the statistic is actually kind of scary. Depending on where you are in the life cycle, 80 to 85% of companies don't make it through to the next stage. And what we've done is essentially devised a pathway where they make it, right? So the last what-if question we have to ask is, where in my valuation or how in my valuation do I factor in that this company won't make it? But hold off on that question till you've done the valuation, because if you let it creep in, as you're doing cash flows, as you're doing discount rates, only bad things can happen in your valuation. Put your optimist hat on, value the company, then after you value the company, say, what do I do next? Like when we start after the break, we're going to start off with a valuation of Amazon. In 2001, actually 2000, at the peak of the dot-com boom. Then you're going to see a second valuation of Amazon a little later in the process. And then we'll use that as kind of a rubric to talk about how to value young companies in general and the issues you run into. Okay? Have a great break. I will see you afterwards.